from myself and Nikki, obviously. This is our first ever webinar that we're hosting. It's all about how to pay for care. So I'm going to, without any further ado, pass you over to Nikki, who is the Managing Director of Elder Care Solutions.
Oh, thank you very much, Sue. So I'm going to quickly nip over and try and share my screen. There we go. And click that slide. So Sue, you're the only face I can see. So can you give me the thumbs up if, oh, she's disappeared. So I hope you can see it. Hope that's all clear. So yeah, good morning to you all. This webinar should take probably no more than 30 minutes or so, and everything that I cover in the webinar is pretty much covered in a paying for care guide that we have. That's something that either Sue can email across to you, or you can download it from our website, or obviously just give us a call for a copy. I appreciate some of you may have family members that you want to kind of pass the information on to. Also, I appreciate that, you know, this is a generic presentation and you've all got specific and personal scenarios. So, of course, it may not answer all of your questions. If there's anything really, really pressing, put it in the chat box, which I'll have a quick look at the end, but we'll make sure we get back to you for anything that's posted there. But as I say, a follow-up call to us or an email just to go through your specific situation if the generic presentation doesn't quite cover it. So the areas I'm going to cover this morning, the reason for this webinar is because the system is pretty confusing. I use that signpost a lot because when our family first dealt with this scenario, that's how it felt. And some 25 years on, it doesn't really feel any less confusing, to be honest. So it's a big old topic. So I've tried to break it down really to the 3 questions that we are most often asked. The first being the basics of who actually does pay for a stay in a care home. The issue around property, does it have to be sold? I think there are a couple of urban myths around this area, so we want to dispel those for you. And then in the absence of any government action to date, even though things have been passed in statute, talk of a £72,000 care cap, that's not happened. And in the absence of anything else, let's have a look at if there's a way that people can take action themselves and cap their own care costs. So that's really the agenda for this morning. Really, I ought to formally introduce ourselves. I know Sue's given you the brief intro there, but just a little bit more information about us. We are a firm of SOLA accredited independent financial advisors, but we specialise exclusively in solutions for funding care fees. So although I've got the qualifications in mortgages and pensions and life cover, it's a long time since I practiced those areas. So I don't regard myself as a good place to get that advice from. Care, yes, anything else, no. And conversely, most independent financial advisors would be really comfortable in giving you advice around pensions and mortgages because that's what they do every day. But if you ask them about a care funding scenario or advice, about solutions for care, perhaps they wouldn't really be competent in dealing with that. So we really do view it as a niche area, and it's all we do day in, day out. The business itself was actually set up by me in 2007 in its current format, and that was as a direct result of, as I mentioned earlier, my family's experience of the care system and my grandparents moving into care, us getting no advice at all, selling the property, the money all being used, and me finding out later on that didn't necessarily have to be the case. More about that later. So we don't have any commercial links with any care providers, but we do work with many. So obviously we're here at the invitation of Sue this morning, but that's purely to get the right information to people that might need it, rather than there being any untoward commercial links there. As you would expect, if we're talking money and we're giving advice around finances, we are directly regulated there by the Financial Conduct Authority and have all the appropriate insurances in place, professional indemnity and so on and so forth. Whilst I'm speaking to you this morning from a sunny blue sky Bishop Stortford in Hertfordshire, location's not really an issue because our service, even pre-lockdown, was always delivered by phone, email, post, and of course more commonly now Zoom. And the reason we've done that is to make sure there's no Chinese whispers, misunderstandings, that we might say something to a family member sat around their house, but then when that gets passed on to the siblings, something gets lost in translation. So we're used to doing sort of either group conference calls or writing our recommendations so that can be passed around in black and white, really. And the good news is as well that any initial consultations with ourselves, a lot of the advice that we give is done at our expense, not yours. So we are a business, we're not a charity, but we do about 90% of our work actually is pro bono, because unless we can find out if we're the right place for you, unless we know whether we can help you, a lot of conversations may go no further than that first consultation. There is a fee to be paid if you instruct us to set up a particular financial product for you, but that's a long way down the line. You would know about that and agree to that long before it happened. So no surprises really what we're saying there. So moving on really to that first question I mentioned in the agenda, who actually pays for care. I'm going to keep this really very simple, and there is more to it than what I will cover this morning, obviously, but in very broad terms, I would break it down and say that there's 3 possible funding streams for somebody in a residential or nursing care home. The first of those would be the local authority, social services, the council. It's fundamentally the same place. The National Health Service may be a possible funding stream, or self-funding. Okay, so there can be some overlap between these, but they're in simplistic terms the 3. If I then take them one by one, let's look at the local authority funding first. This is so important. To be eligible for any funding from social services, an individual has to meet their care needs eligibility criteria. In simple terms, the council has to think somebody is poorly enough to need to go into a care home before they would consider funding them. Okay, and it does vary across the country what that criteria looks like, but that's the first and foremost. Everybody's entitled to a care needs assessment. Indeed, carers can have a care needs assessment. It's a case of ringing the Adult Social Care Services Department and asking for that assessment. So that comes first. It's only after the care needs assessment has taken place that conversations about money should happen. Now, we do know of cases, lots of cases, where the first question is, well, do you have a house, for example? That's not the order it is supposed to run in. It is supposed to be assess the care needs, draw up a care plan, then work out who's actually going to pay for that and start having the conversations about the money. So the magic figure, you probably may already be aware of this. The key on the financial assessment is to ascertain whether the person has above 23,250 in capital. That's the figure for England and Northern Ireland. In Wales, it's a much more generous 50,000. So go figure. But that's the magic number. So whether you have above or below that. So what are they looking at? What counts towards that amount, that capital limit? Well, I could be quite flippant and say pretty much everything, but there are a couple of notable exceptions. I've put three up here. If you own money assets jointly, then only 50% can be taken into account. So in a married couple scenario, quite often we'd recommend separating out any joint accounts. You don't fiddle with the balance, you keep it as 50-50, but you just separate it out. And 100% of anything that's owned by the spouse, if married, and the spouse that's not going into care. So again, it's really important for couples to be aware of that. This one, I'm sure, is more commonly understood. Your property, if a spouse or relative over 60 lives there, the spouse is the main one, obviously, but sometimes more commonly relatives over 60 living in the property. But it has to be a genuine arrangement. If mum moves out to the care home and daughter age 62 moves in the day before, that won't wash, that won't work. It has to be a genuine cohabiting relationship in that sense. But the house is a disregard. It's not retrospective. We've seen more and more families being told that the money would be reclaimed at a future date. While the spouse is in there, it's invisible, can't be taken into account. And then a lesser known one, but always worth a mention in these situations, an investment bond, a particular type of investment bond that includes life assurance, is a disregarded asset. Often families don't really know if mum or dad has one of these. They're quite easy for us to identify. The paperwork would normally have the words Mr. and Mrs. whoever, lives assured, that might be written on there. The sorts of companies that offer these bonds would be names like Aviva, Scottish Widows, Legal and General, rather than Barclays, Abbey National, the Nationwide. So you're looking at investment banks and brokers rather than building societies. And as I say, having this life assurance wrapper around it, don't ask me why, it's an old piece of legislation, but those are disregarded. You could choose to use them, but you shouldn't rush to encash them, because the minute you encash them, then they are included in the means test. So just be mindful of that. And if you're not sure if someone has them, we can check. So that's capital. But it's not just about capital. Yes, the 23,250 is the entry point, but somebody's income is taken into account as well when the local authority do their means test or their assessment. So again, in a married couple scenario, you can, with a private pension, pay 50% of that over to your spouse. They can retain that. But your state pension, any other income, that has to be put towards what the local authority agree to pay for you. Okay, so again, some people think that they'll get state funding and they can then use their pensions to top that up. No, your pension is used together with the local authority to form their contribution. So that's quite again a common misunderstanding. So local authorities will have a limit on what they'll pay. It's not meant to be an arbitrary limit. They're not meant to just have a fixed amount that's what they pay for everybody. They are meant to assess needs and pay for those needs, but the amount that they'll pay will generally be driven by the contracts that they have in place with certain care homes. So if they are assessing somebody's needs, there should always be a care home available to meet those needs that the local authority will cover the cost of, and no top up should be required. Okay. But should you choose a different care home to the one on offer for whatever reason, then of course that care home is perfectly at liberty and more than reasonable for them to ask for a third party top up. And also the scenario where somebody's moved into care paying privately, if the local authority later take over the funding, if it's not at the same level, again, that's when sometimes third party top-ups can be requested. Okay, so that's really how the local authority funding works. So that's all the means tested, how much money do you have as to whether you get funding or not, and it's all really driven around personal care needs, so help with washing and dressing. If you're however, primary need is a healthcare one, so perhaps a condition that ordinarily would be funded in a hospital bed. Well, if you have complex needs, then the NHS, in the same way that they would be paying for that bed in a hospital, they ought to be paying for that bed in a care home. So just because the setting has changed doesn't mean that they're absolved of any funding responsibility. This isn't really our area. We work with lots of experts here that can support people in claims for NHS continuing healthcare, as it's called. But a word of warning, the things they are looking for, they use words like unstable, unpredictable, and complex. You certainly need to have a nurse as part of your care plan. So if you're in residential care with personal care needs, this isn't going to apply. It might apply further down the road, obviously in somebody's care journey. So you may have heard of it. It's quite difficult to get, and there is actually a lower level. There's a level beneath this where if you don't qualify for full NHS funding, they will at least pay a weekly contribution. I think it's just under £184 a week, paid directly to the care home. So it's worth knowing about. It's certainly not the most common form of funding, however. So if you don't qualify for state support because you have effectively too much money, and you don't qualify for NHS funding because you're not poorly enough, then that's really the definition of a self-funder or a private fee payer. Probably the only good news I have for you this morning, if you're not aware of it, is that as a self-funder, there is a state benefit that you can either continue to receive if you were claiming it before, or you'd certainly be eligible to claim it now. And that's, as I say, attendance allowance, non-means tested, tax-free. It's claimed from the Department of Work and Pensions, so the same people that pay the state pension, it's paid in the same way. And the difference between, in practical terms, the difference between that day rate and the day and night rate is if you are deemed to need at least 20 minutes of attendance during the night time. So I remember filling in this monstrous form for my mother-in-law, and the key was when talking about perhaps accompanied visits, bathroom visits at night, to get the 2 or 3 visits to add up to at least 20 minutes. That was the key. If we had said it was 10 minutes, she'd have remained on the lower rate. So unless that's changed, that's my tip of the day. So this is definitely something that carries on if you are self-funding a care home place. So that's the good news. Over. Unless you have a house and your house is the main asset, okay, by which I mean that the other money is under the 23,250 threshold. If that's the case, then there may be some temporary assistance when a move into care first happens, something called a 12-week property disregard. So it's the case that you still have to meet the council's eligibility criteria, which we talked about earlier. So I mentioned that, you know, if you wanted a move into care just because you felt a bit lonely, a bit vulnerable, then if you didn't meet the criteria, the council wouldn't pay. Same applies here. You wouldn't get the 12-week disregard. But if you meet the council's eligibility criteria and you have a property that's being left vacant and you're moving into care on a permanent basis, the local authority has to ignore that property for the first 12 weeks, and they have to pay for you in the same way that they would pay for somebody who was their full responsibility. So what I mean by that is you would only get the local authority limit of payment. You'd still have to contribute your pension towards what they pay, but it's something. You don't have to pay it back. You do have to jump through all the hoops to get it. That involves the assessments and involving social services, and some families that we deal with just can't be bothered. Quite frankly, they work it out and say, well, the most we would be getting would be, say, £150 a week for 12 weeks. It's just not worth the bother. We won't apply for it. But you do need to know about it. And the care home, because you are a self-funder, getting some temporary support from the council can and perfectly are within their rights to be charging a top-up during that time. And they can charge the individual the top up. It doesn't have to be a third party. This is an exception to the rule. Okay, so worth knowing about. You weigh up whether you think the pros and cons of getting involved with social services for that funding is worth it, but it is there and it doesn't have to be paid back. Now, for most people that we talk to, do you have to sell the property? There is this question. Certainly the council never take a property from you. They will never take your house, which is language we do sometimes hear. But if you do have a house that is vacant and does form part of the means test, it does mean you are a self-funder. You don't have to sell, but they're not going to pay. However, lots of people aren't aware that they might lend you the money that you need. So in most cases, the care home fees, even with attendance allowance and pensions, and maybe even with rental income, if you decided to keep the property and rent it out, they are still short. Those 3 income streams don't always cover the fees. So anything you are short by, the local authority has to offer a deferred payment, a deferred loan, for want of a better word. So all councils, it's not pick and choose, all councils have to offer it. They can pick and choose which property they might offer it on. So if you had a property that a mortgage lender wouldn't lend on because it's built on a floodplain, for example, then of course they can decline it for that reason, or if it's very, very low value. or indeed if it's already got a mortgage on it, if it's already got an equity release, for example. But other than that, they do have to make the scheme available. And the interest rates are pretty low, circa at the moment 2%. There is a setting up fee, but you're only charged interest on the amount that you're borrowing, which may only be £1,000 or £2,000 a month to start with. So the interest isn't really too significant, and the property value may go up during that time. So worth knowing about from that sense. You don't pay the interest, it just rolls up and has to be repaid on the property owner's death. So we talked about that. You have to meet the eligibility criteria and you have to have less than 23,250. But the good news here is the council can lend the full fee. It's not restricted to the local authority rate like the 12-week property disregard was. Okay, so it can work quite well in certain scenarios. Of course, if you are renting the property out, you do still need to be mindful of all the issues that go with being a landlord, like being woken up at midnight because your tenant's boiler has just burst, but and finding a tenant and having void periods, and you have to pay tax on the rental income. So lots, I'm not making it sound as if it's the ideal solution, but if you've decided to rent a property out and the money's still short, then this could be the route to go. And as I say, the 12-week disregard should happen first. This should happen thereafter, and it's only this element that it has to be repaid. So hopefully you're all still with me. I know I'm talking fast, there's a lot to get through in this half an hour. So moving on to the options for self-funders, the families that we talk to have really two main concerns. The first is they'd really love to know how long they've got to budget for and to be able to do their cash flow forecasting, but they haven't got a crystal ball. No one really knows how mum or dad might adjust to the move and the environment, and really we have no idea, do we, when someone moves into care, how long they might be there. So that does make it difficult to plan financially. The other concern we almost always hear is that, you know, mum or dad want to leave something to their beneficiaries, of course. So we're worried about them not being able to do that. But also, what does happen if the money runs out? Is the local authority going to be able to come to an agreement with the care home and for that person to stay there? So these are the two overriding worries, and this is what we on a daily basis try and solve where we can for families. Now, there is a solution. I do not for 1 minute want to make this sound like a panacea. It doesn't work for many people for a number of reasons, but what we do know is that 85% of self-funding families have never heard of it, and this is the sole reason the business was set up, to try and bring that percentage down. I can tell you about the solution and you can take no action. That's fine, because you now at least know about it, so you're able to make informed choices. So one assumes you don't know, and one assumes you're part of the 85% in popping onto this webinar, but I'll take you through it so that you are no longer in that 85%. So it's a financial product, and it's a solution that would enable a person to cap those costs themselves in the absence of any current other state alternative. The word insurance, I think, is quite well understood. So I'm using it here to say that you can insure care home fees. Now, it's really odd that you would be able to do that, because a car that's wrapped around a tree, no insurance company is going to insure it. No house insurance company is going to insure a house where the bathroom ceiling has just collapsed. Yet, if you've moved into a care home and the event has already happened, you can still insure those fees. So the technical term, the technical name for the product is a care fees annuity, but whenever we use that phrase, it conjures up images of retirement annuities, which are not that popular. Why? Because a retirement annuity is taken out when you're maybe 60, 65. You no longer have to do that, by the way. We have pension freedoms that mean you don't have to buy an annuity, but when you did, they were perceived as poor value, because you would be swapping a lump sum for an income, and the insurer had to pay you for maybe 30 years and maybe had to put a widow's pension on there and indexation. So the actual amount of money, the lump sum that you had to swap compared with the income you would get, was a pretty poor ratio. it's the same principle with a care fees annuity. You're still paying a lump sum up front, and you're getting a guaranteed tax-free income for life, okay? But the difference being these are individually underwritten and take into account somebody's age, which is not likely normally to be 60 to 65. Our average client age currently is 88. So they take into account the person's age and absolutely their state of health, and take on board the fact that their life expectancy will be much reduced compared to somebody who would be taking their pension. So it's important that they're portable. Somebody might start off in one particular setting and buy one of these to pay their care fees at a particular home or in their own home even. And if they were to move, it's important to understand they can take that income with them. Fees are likely to go up every year, so there's the option of putting an indexation on the policy. That still, even though we know fees will go up, you don't have to index link this. At the end of the day, these policies are a gamble of sorts. So you might decide to cover fee increases from the money that's left and just build in a level income. So there's lots of options, lots of flexibility around these, and it's our job really to guide you through all of that and advise you on the things you need to consider. Of course, I mentioned that word gamble. That is what they are. You pay the lump sum. The benefit is if the person lives longer than the insurance company predicted, they still have to pay. So that worry about the money running out and what happens if I've no longer got the income, that's all taken away. But of course, there has to be a downside, the too good to be true scenario. And that is that if somebody bought one of these and passed away much sooner than the insurance company had predicted, then ordinarily there's no return of capital. That's on a standard plan, but you can pay a little bit more to have extra protection, and you can even buy these on a deferred basis, which just means like a staggered start date. They cost less to buy up front. Interestingly, of the insurance companies that do these, I'll talk about who they are in a second, 50% of them have brought out a COVID-19 money back guarantee, which is basically saying if there were a death due to COVID, if that appeared on the death certificate, all of the money in the first 12 months would be refunded, less anything that had been paid out to the care home at that point. So that's quite reassuring at this tricky time, I think, as well. And it would be foolish not to ask this question really in the current climate, but if you were to buy one of these plans and the insurance company went bust, then you need to know they're fully protected by the Financial Services Compensation Scheme, and that's to 100% of the income with no cut-off. So the money in the banks and the building societies, that would be limited to 85,000. That's not the case with these policies, all right? So that's really important to be reassured as well. So the two real reasons that people might buy these, if they're affordable and if they look at the pros and cons and decide it's for them, it's to ring fence the remaining assets so that once the policy is purchased, the remaining money in the estate is safe and ready to pass down as per the terms of the will. And it avoids that scenario that we talked about of A, applying for local authority funding, and B, hoping that it will cover the care home that the person is currently in. So it's that peace of mind scenario really. And if somebody bought one and later on they qualified for that NHS funding that I talked about earlier, then they would still receive the income from this. So it genuinely is an income for life. It would be paid to them, and so it would suffer a small tax deduction, but it is still paid to them. It doesn't stop in that scenario. I mentioned right at the beginning about the sort of pro bono work. Researching one of these and giving an idea of costs and getting quotes, that still comes under the pro bono, because we believe that families can't make this decision unless they have the full facts, and putting a charge in up front for something that they may end up not pursuing, in our opinion, that's proven to be prohibitive. So we've made a business decision to carry the cost of that. So we do all that research, give you the facts and figures, and then you pay us an arrangement fee if you end up purchasing. That seems to be the way we feel comfortable with, and most of our customers do too. You could argue there's an element of cross subsidy. You're paying for the people that don't pay, but when you enter the process, you don't know if you'll be one of the ones that ends up not buying. And so we've settled on that. So in terms of the research that we do, as I mentioned before, we are independent. In terms of care annuities, there's a very limited number of providers that do these plans because it's not very well known about, as we talked about with the 85% statistic. So until there are more and more people wanting quotes, then there won't really be any further players. But who we have currently and who we can get quotes from are Aviva, that you will surely have heard of. Just who you probably won't unless you have an equity release product or a retirement product. That's their sort of niche area, but we've been placing business with them for as long as I've been advising. Legal & General you'll have heard of as well. They're a newcomer to this particular market, and they actually chose Eldercare and myself to pilot their product and bring it to market. That is now available through any other financial advisors that are care qualified. But this fourth provider, National Friendly, also approached ourselves as a specialist to design and launch their product, and they've been really happy with the way the pilot has gone, the way that we give our advice, and they're not looking to make their product available through anybody else for the time being. So we are the truly whole of market option. There is no other financial advisory firm in the UK that can get you the full range of care annuity quotes, and the price difference can be tens of thousands of pounds between them, and we never know until we get the full set of quotes who's going to be the cheapest. It is not a case of saying, for 92-year-olds Legal & General are always the cheapest, and for 85-year-olds Aviva are always the cheapest. It doesn't work like that. You need to get all 4 quotes every time to be sure you're getting the best deal. So they're the 4 companies. To get a bit of a feel, because I know I haven't answered the question that most people interested in that product want to know, how much will it cost? That is, I'd sound like a politician dodging it, but it is difficult to say because every case is different. But we've developed on our website, so Eldercare Group is the website address, there's a care fee annuity calculator there, and you only need to put in, I think, 3 pieces of information, which is the age of the person, the cost of the care, and roughly how much existing income they already have. And then this would be able to give you a very broad idea, just a ballpark figure really, based on quotes that we've obtained for other families. So at least that would give you a sort of start point if you haven't got a clue what this would look like. And then of course, yes, you can get in touch for more information about it. So that's where I would suggest you start if this product sounds of interest. As I say, it's not meant to be a panacea, but in our experience, for most people, they don't have those inordinate pots of money that can't possibly run out. Most of them can see a point at which the money may run out, and investment solutions, as good as they may be, and in the current market, to get good returns, you have to take some risk, and that's not something most attorneys would do. So an investment solution might make the money last a little bit longer, but it doesn't solve the issue of it potentially running out. So as I say, not a panacea, but 85% of people don't know about it. You now do, and if you want to find out more, then as I say, that's probably the best place to direct you. The Paying for Care guide is on there as well, as are our contact details. So I'm just going to quickly stop the screen share, nip to the chat box just to make sure there's, okay, I will pick these up because they're very, very valid questions. Yes, I don't know if the attendees can all see it. So one of the questions is whether the local authority care eligibility has to specify residential care as opposed to care in one's own home. Yeah, that's the point of the care needs eligibility, is to draw up a care plan. And if the council think that care can be met in your own home, that's what their recommendation would be. And they wouldn't then look to be funding a stay in a care home. So yeah, absolutely, they will identify that. And the second one, I was asked this yesterday by a magazine, a reader wrote in and asked this exact question: does putting a property into trust avoid sale and counting as an asset? It's quite difficult to answer that simplistically. Again, my politician answer, but if it is documented or seen in any way that the property being put into trust was done to avoid care costs, it won't work. So we've seen protective property trusts advertised with a strap line, protects the house from care costs. Straight away, the local authority could say, if they got wind of why you did it, well, you only did it to avoid care costs, so we're going to treat you as if you still own it. So it's all around the timing that you do it, the age that you are when you do it, your state of health when you do it, and how the solicitor normally that's doing it records the notes about the transaction. So I would always say to people doing this is have a think about where it leaves you, because if you actually give your property away and you put it in trust to your kids and one of your kids gets divorced or one of your kids is bankrupt, then that puts you in a pretty difficult position. Also, you may never need care, but you've given your asset away. So there's lots of things to think about, and you don't then get choice. So that's overlooked often, that if you have a property and you sell it, you've got choice what you do, where you go. If you don't, then you're funded by the local authority. You go where they say you go. So there is a legitimate way to do this, which is around owning a property as tenants in common, husbands and wives, and then not leaving arguably your halves to each other, but leaving your halves in a will trust. That's very different. So that's all around tenants in common, and that's absolutely fine to do. But both of these points, really, if you're thinking about any of that, need to be picked up actually with a solicitor. So that's where I'm going to direct you. And I've just noticed on the Q&A chat, sorry, rather than the chat, would a 71-year-old qualify for a care fee annuity, or is it likely to be prohibitively expensive? We'd say get the quotes, because we do have 65 and 67 and 69-year-olds that have bought these. Yes, they're obviously much more expensive than a 90-year-old buying them, but so would the cost of care be without an annuity. So it's sort of relative, and it depends if the person's got a reasonably high income or not, lots of other factors. And as I say, the doctor is often written to, the medical information taken into account. I would say get the quotes just to see. There's no harm in so doing. But age is not going to be an issue. You can have them from 65 upwards, no maximum. My oldest client was 103. So there you go. So that wraps us up, I think, Sue, unless you've got anything you would like to add.
If anybody has any questions for me, but if anybody has any questions for Nikki that you want to take offline, I will be happy to put you in touch. I hope you've enjoyed our first webinar. Thank you very much, Nikki. That was great. So yeah, if nobody else has any questions, we'll wrap it up, and I will look forward to speaking to you all again very soon.
Lovely. Thanks, Sue. Thanks for the invitation. Thanks for everybody attending. All right. Take care then.
Thank you.
Bye.
Bye-bye.